equity mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates. Our aim is to help you on your investing journey, break down the barriers from beginning to dividend. Whether you're an absolute beginner or Warren Buffett, we guarantee that Equity Mates will have something for you. My name is Bryce, and as always, I'm joined by my equity mate, Ren. How are you going?
I'm very good, Bryce. I'm very excited for this interview. We've got a superstar fund manager joining us.
Yes, big star. Looking forward to it. It is our pleasure to welcome Emma Fisher to the studio. Emma, welcome.
Thank you very much for having me. I'm very excited to be here.
So Emma is portfolio manager and head of research at Airlie Funds Management. She co-manages the Airlie Australian Share Fund, which its ticker is AASF on the ASX. Emma, we always start with a game, so let's get stuck in.
So the game is overrated or underrated, where we throw out a investing theme or index, and we just get your thoughts on whether you think it's overrated or underrated at the moment.
Love a game.
So we'll start at home with Australia's benchmark index. Overrated or underrated the ASX 200?
Look, I think in the long term, it's underrated for Australian investors. I'm assuming a lot of your listeners are local investors. And I think, you can't underrate the value of investing in your own backyard in businesses that you see, the experience as a customer, you understand them. I think another thing in favour of the ASX, investing in the ASX, is from a tax perspective, the franking credits and the dividend structure. As well as, when you look at Australia and compare it to overseas markets, we have a small but wealthy population. So you have these profit pools that often only really support maybe two or three players. And so, hopefully ACCC isn't listening, but, you do tend to get these really cozy oligopolies and businesses that do have phenomenal returns profiles as a result of that. Like, I always think when I go to London, I'm just sort of assaulted by the amount of advertising and competition there is. There's like 5 big supermarket chains, there's 5 or 6 telcos, and then I come back to Australia and I just think, oh, it's so sleepy. It's and New Zealand's the same, So for investors, I think that long term it's underrated. I think there's some really good businesses here that can earn really good returns.
Yeah, nice. So then overrated or underrated the NASDAQ 100?
Oh, I'm going to say it's overrated.
Wow.
Look, there are some businesses within that index that I'd love to own, bottom drawer, businesses like Microsoft for sure. But as a whole right now, I feel like we've been here before, guys. Like EV to sales into perpetuity, my problem with it is, everyone reads these statistics about, I guess, the proportion of loss-making businesses in the index is becoming, as high as it was in the tech bubble. And the issue with that is, if you require equity funding to sell the dream and to fund your business rather than it being funded through your internally generated cash flows, you're relying on the equity window always being open, and it's not always open, and it won't be open, and it will have nothing to do with these tech companies. It will be a global sell-off. So we saw it in March last year. If you'd had to raise at that point in time, it would have been very difficult to do so. And that was an anomaly of a downturn. Like if it was a downturn like the GFC, where the equity window would have been shut for these companies for 18 months, for 2 years, a lot of them would have gone bust because they couldn't have funded their operations. So I think that's a really big risk that people are taking. And I think, you might disagree. We might have different views on where we are on the valuation clock, but I think most people think it's 11, it's 11:30, like midnight is coming. We've got to drive home. Like it's not the time to be doing tequila shots. So
I was looking at Snowflake's valuation yesterday, and it's 141 times next year's projected sales. And it's just like, when you think of that, it's just...
I know, but I mean, oh God, I imagine we can get into this a little bit later, but Afterpay is also on 80, 90 times trailing sales. So, I mean, all it says is, you're like, all you can make a judgment about is risk reward, right? And so for me, I think the risk reward for a lot of these loss-making businesses looks pretty negatively skewed.
Speaking about risk reward, overrated or underrated GameStop? and given that it's dying down a little bit, I guess more the GameStop saga itself.
Sure, yeah. Well, okay, so the stock itself is clearly overvalued by any normal sort of valuation metrics. But I guess as a saga, or what it's telling us about society, I don't think we should sleep on this. whenever wealth inequality gets as stretched as it is right now through history, you see revolution. And I think it's kind of funny that we had French Revolution, Russian Revolution, Chinese Cultural Revolution, and today's revolution is just a bunch of guys on Reddit, buying meme stocks up, in perpetuity.
Crazy.
But I think that, if you actually go on the Reddit forum and you see what these guys are saying, it's clearly there's this mentality that, the asset price inflation coordinated by central banks, it's led to this world where the haves have increasingly more. If you own assets, if you own a house, if you've been in the share market, you've seen your wealth expand. And if you haven't, then you've been left behind. So, even though everyone over time, over very long time periods, everyone's absolute level of wealth is rising, wealth is such a relative concept. And if everyone else is getting richer than you, then you feel like you've been left behind. And I think, you read some of the stories in this forum, it's people that want to stick it to Wall Street because their parents lost their jobs during the financial crisis and they feel like everyone got bailed out and no one was held accountable. Like, I think they picked the wrong target. I mean, hedge funds weren't bailed out. It was insurance companies and banks and things like that. So I think and the other thing that I think is a shame about it is I think shorting, we're a long only fund, but I think shorting is a force for good in the market. Without shorting, you will have rampant fraudulent activity. And that's going to mean that retail investors are much more likely to be burnt. So I think it will be anything that, that threatens shorts as a force in the market long term is bad. But I think we should be paying attention because, the markets right now are priced for perfection. They're not priced for revolution, I guess. And this seems to be revolution.
So Emma, overrated or underrated the Australian property market?
I think it's underrated. I think, again, from a tax perspective, that the tax system is geared towards you making the bulk of your wealth through your family home because you don't pay capital gains on that. And then clearly the mortgage market is considered too big to fail. So you get this coordinated policy response from fiscal and, the Reserve Bank and the government designed to keep property prices high because they're so endemic to our economy. So I wouldn't want to be short Aussie property with that kind of backdrop.
Yeah, you'd lose a lot of money.
Exactly. And it's, it's maybe long term, it's not a very attractive ROIC, return on invested capital, but it's very attractive ROE because you're using other people's money, you're using the bank's money. So yeah, for those reasons, I think it's probably okay.
And then final question in the game, we couldn't go without asking about cryptocurrencies. So overrated or underrated Bitcoin?
Yeah, I feel like I should have a really strong answer on this because I guess technically I'm a millennial, but the short answer is I don't know. If I had to pick a fence, I think buying one Bitcoin and putting it in a bottom drawer is probably not the worst thing that you could do. I understand why people are buying it. Maybe I could propose an alternative investment, which would be if you're trying to protect your purchasing power in a world where everyone's control P on, the money press, I would suggest gold. Gold has a 3,000-year history of protecting your purchasing power. Bitcoin, sadly, gold mining is probably better for the environment than Bitcoin mining as well. I don't know, actually. I'm just guessing that.
That's actually a good question. Yeah, I'd love to know that.
Yeah, we should put them head to head. But I just like the track record. I like the track record of gold. But I think it's pretty sensible to react to what's happening in the world with some sort of view that, you might want to put your money into alternative assets versus the US dollar.
So, Emma, we always like to hear the story of our guest's first investment and perhaps any lessons. So are you able to share yours with us today?
Sure, yeah. I think technically my first investment was my grandfather gave my sister, my brother and I 50 Commonwealth Bank shares when we were 10. And I paid no attention to it except that I got a dividend check twice a year that I probably used to buy lollies or something. But I do remember in high school looking at the paper and looking up the share price in the paper. And that sort of sparked something in me, but I never really paid attention to it. But I did always like making my own money. I had a paper run at 11. I begged my parents to sign a waiver so that I could get a job below the legal age. I mean, I wasn't being shipped off to the coal mines or anything. I was working at Video Easy, but my older sister had a job. She worked at Baker's Delight. She used to bring home bread. She could buy her own clothes. I was like, I've got to get on this racket. This job thing sounds great. So I had all these menial jobs through high school, through uni, and I always earned my own money. And then investing, I think, was the next step about liking making my own money. My grandfather, I think I would have been about 19, he gave me an annual report, Commonwealth Bank annual report. He loves the Commonwealth Bank, clearly. And he had it open to the page, like the board of directors. And I think his argument was like, oh, look how many women there are. You could do something like this maybe one day. And it just sort of like led to a discussion about what an annual report was. You know, you get it once a year in the mail and it tells you how your business is doing. And then from there, like I think he was just desperate for somebody in his family to invest with him. I do not come from a family of investors. My mum is a school principal. And my dad works in industrial relations. So like, I'm the first one without a real job, basically, in my family. So, you know, it was definitely my grandfather's influence. Like he was a child of the Depression, very cautious about money. And I think he loved this idea, like he's a classic dividend investor, loved this idea that you could put a lump sum of money to work for you and produce an income. So I think the first share, so he showed me how to open a trading account, and I think the first shares I bought was QBE, and then I just did that classic rite of passage where you're in uni and like your mates are giving you tips and you're buying like these spivvy mining companies. You've got, it's actually interesting. It reminds me a little bit of like when you read Wall Street Bets.
Yeah.
Like you read these people, and I remember being 19 and like thinking just because I owned something and I really wanted it to double, that it was going to double, like just because I wanted it to. And like that was my thesis. Like I'd bought it. I knew the ticker, like what more do you want sort of thing. And I mean, I can't remember. I probably lost some money on some spivvy, I think a spivvy graphite company. And basically at that point, like I had the bug and I also thought I needed to figure out what I was doing. So I I was doing commerce law, hated the law, dropped that, and I transferred into finance. But you know what, like, when I look back, I actually don't think you need to study finance to do this job.
Oh, I hope not, because the advice I have.
No, I actually think it's a bit of a waste. Maybe I'm being controversial saying this. It's a little bit of a waste of time. Like everything I've learned about investing, I've learned on the job or I've learned through reading books. I think you can really self-teach it. There are a few concepts I got at uni, but I think I would have come to them anyway. So when I was working at Fidelity before I was at Airlie, and they would send all their new recruits to London. And so you'd be, I wasn't a graduate. I'd had a role in an investment bank beforehand, but we would go and we would work. We did this sort of intensive training course with a bunch of graduates from the London office, and they'd all come out of like Oxford and Cambridge, and they had to do this crash course in finance for 2 weeks before they could do the course with us, because none of them, they'd all studied like geography and Russian literature and things like that. And they got it in 2 weeks.
Yeah.
Like, in 2 weeks. And I thought, I should just, if I had my time again, I would have, studied something way more interesting at uni than I love finance, but corporate finance, like, Modigliani and Miller and dividend theory and all of that, like, someone else can have it. So if I had my time again, I would have done something differently. But yeah, that was my path into investing. And I thought I had to study finance to get better at it. But really, it's just, it's reading the books, it's reading the Warren Buffett letters, like what everyone does.
Yeah. So you're now at Airlie. You're a portfolio manager there. Before we get into talking about what you do there, have you developed a personal investing philosophy?
Yeah. So I think, at Airlie, the investment process is we look at balance sheet, we look at business quality, we look at management quality, and we look at valuation. And that's how we pick stocks. But I think any portfolio manager or any investor really also brings to it their own experiences, their own concepts. And for me, there's been a few things that I've come across in my career that like these concepts that really have stuck with me. So the first one, and I've just rubbished my finance degree, but I did learn it. I did learn it during my finance degree, was this concept that financial markets are secondary markets. So they exist to allow the real world to access capital. And I think that's a really important concept to never lose sight of, that you're investing in a business, and all of the stuff that we talk about every day, like, liquidity and volumes and trading and PE multiples and things like that, that's all the secondary world. That's financial markets. You're buying a piece of a business in the real world that has customers and, costs and things like that. So that's a really important concept to, I guess, focus on. And then the second thing, and it flows from that, is that businesses change slowly. They change with the fast pace of disruption, they're changing over years and decades. Whereas in the stock market, their prices are changing really quickly. Like if you have a look at the 52-week high and low for, the ASX 200, in a normal year, it's moving on average by about 45 or 50% from their highs and their lows. Like a year like last year, it's probably like 60 or 70%. And that's interesting because we know that these businesses aren't changing in true value by 50% in a year, but these opportunities are coming our way. And so that's always that's what's enticed me into financial markets. That's why I find it exciting, is you always, every day, have an opportunity to find a mispriced asset. And then finally, the thing that I think about the most, I guess, is that when you're investing, the thing that's going to determine the success of your investment is the economics of the business that you own. And I think about it like as a personal investor, if I wanted to start up a business, there's not many opportunities that I would have to put my money to work and earn an attractive return on capital. Because basically everything that is available to me is going to have pretty low barriers to entry and as a result, probably pretty marginal returns. So like I could start a cafe, I could start, maybe I could start a competing podcast, but I'm sure you guys are, probably in the, you guys would be in the super profit space. You clearly stumbled upon a very successful niche, but I could start a hair salon, things like that. And traditional economic theory is just going to bid down my return to a normal level. But through investing, I can access these businesses that do have high barriers to entry, that do have huge moats. And I can just hitch a ride to these businesses that have phenomenal opportunities to allocate capital and earn high returns. So I've always liked that concept, and that's something that I always kind of keep in mind. And, as everyone I'm sure has read about, like the power of compound interest. So holding these businesses for the long term, I think is a really powerful and exciting concept in investing.
I actually love that idea about everything we could do has low barriers to entry. So why not hitch a ride to a company that has a real moat? I'm definitely going to steal that and use that. So,
well, I think, in the start, and you guys, you run your own business, so you'd understand this. Like at the start, it's a really hard slog and it's very difficult to make a return. And then if you stumble upon a really good idea, eventually you can make phenomenal returns. But, maybe you could just short circuit that and invest in these really good businesses along the way. Like I'm not trying to dissuade people from starting their own businesses. I'm just sort of saying, hey, in the background, the share market is there. And I think it's I really believe that everyone should learn the basics of investing and buy stocks themselves.
You've covered off two things that we try to talk a lot about on the show, and that is you don't need a degree to start investing, and that the share market provides an awesome opportunity to invest in the brightest minds around the world from your bedroom, which is pretty phenomenal. So, hitch a ride, we'll definitely use that one.
I feel like at some point I should plug the fact that you could also invest in the Airlie Australian share fund.
No, we'll get to that.
We'll get to that. But
also do it yourself.
Yeah, we'll get to that. But before we do, we need to protect our podcasting super profits. And
you've heard about them, guys. Come for them. Come for them now. Launch many podcasts.
So we'll just hear a quick word from our sponsors. So Emma, as we touched on before, you're the portfolio manager for the Airlie Australian Share Fund, ASX ticker AASF, if anyone is interested. So I guess for people who haven't heard of Airlie before, can you maybe give us an overview about, what you do, what you invest in, and, just a bit about Airlie?
Yeah, so a little bit about the history of the business, I guess. So it was founded by John Sevior in 2012, and the portfolio managers that I work with are John and Matt Williams as well. So John and Matt, before I joined Airlie, I'd heard about their reputations. They have phenomenal reputations in the market as really good investors. They've both been investing for around 25 years, and they really built Perpetual into one of the most, I think probably at the time, the largest domestic fund manager. And then John left to start Airlie, and eventually Matt joined him. So we were running for a few years as an institutional only business. So we were running about $8 billion of primarily super money. And 3 years ago, Magellan acquired us. So the thinking there was that, John loved picking stocks, but when you're running a business, as you guys would know, there's a whole bunch of admin and in our industry, a whole bunch of compliance that takes you away from your day job. So the tie-up with Magellan really allowed us to give all of that back office to them, and they do it fantastically, as well as bring a retail product to market. So this Airlie Australian Share Fund launched just after we were acquired by Magellan. So we launched in June 2018. So we're coming up to our third year of running the fund. I run it with Matt Williams. And the partnership with Magellan has been fantastic. They have, world-class marketing and distribution people, and it's a really high-quality business.
Yeah, nice.
Yeah, we're big fans of Magellan.
Yeah.
Yes.
Yeah. And we hate admins, so...
Yeah. No, what I really respect about Magellan is a few years ago they came out, and I promise you Hamish hasn't slipped me $50 to say any of this. A few years ago they came out and they said, we sort of unabashedly put our unit holders and our investors first before our shareholders in, the listed MFG. And I think that is a really good concept. Like, we talk all these trends in the market about ESG and social license to operate and things. I think a lot of companies would do well to sort of sit down and think more broadly about who their stakeholders are, who their end customer is, versus this kind of, again, I guess I've always been taught that the role of a board is, and the role of management is to maximize value for shareholders. But even that is a little bit problematic, because it's sort of like, well, what time frame, which shareholders? Is it the long-term shareholders, or is it the people that are just there for a quick buck? So, Magellan founded their business. You asked before about Airlie and how we pick stocks, and one of the things that we always like investing in are founder-led businesses. Now, obviously, we can't invest in Magellan, but we own a number of businesses in our fund that are run by the original founders of the business that have huge skin in the game. Some examples of that in the fund will be Mineral Resources, Premier Investments, Nick Scali. There's a bunch of them.
Yeah, nice. Well, speaking of stock picking, the fund is quite concentrated, investing in between 15 to 35 stocks, thereabouts. How do you think about managing, I guess, such a tight concentration of stocks?
Yeah, so I think firstly you have to believe in concentration as the road to outperformance, which we do. I look at businesses, conglomerates, and most of the time people will apply a conglomerate discount in their valuation, because there's this view for businesses that diversification is sort of diversification, that you have good businesses and net it off against the average businesses and you're left with a sort of like middling bunch. And I think it can be the same if you own too many stocks. Like, I always think you only have so many good ideas at any one point in time. Like, why would you want to dilute those good ideas with less good ideas? So I think, concentration is something that I believe in for investing. I don't think you just have to diversify away any sort of idiosyncratic risk, because then you're probably just going to get a market-like return. So you have to believe in it. And then secondly, you have to know the source of your conviction. Like, you are taking big positions in companies. The composition of your fund won't look like the composition of the index, so your returns won't look like the index, and hopefully in a positive direction over time. So, you have to know why you own a business, and you have to do the work. Like, if I think about from a concentration risk perspective, a few years ago, we had our largest absolute position ever in CSL. Now, CSL is a big part of the index, so I guess to express a positive view on it, you do have to sort of tie up, I think at one point it was 8 or 9% of our capital in that one business. And that was a function of, doing the work, I guess. So for CSL, I went to Europe. I met with, there's not that many players in the industry, so you meet with them all. And the thing about CSL is, from a supply perspective, it takes 3 to 5 years to open a collection center and have the new product available to meet demand. So you have to be putting into place now the supply decisions for the demand that you see in 3 to 5 years. So when you meet with all the competitors and you say, how many collection centers are you rolling out this year and next year and the year after, you can build an industry model, and you can, if you take demand, which for 3 decades has run at 6 to 8%, and you grow that at 6 to 8%, and you then see how many collection centers everyone's rolling out, it was pretty clear that CSL were the only ones that were rolling out enough to meet market demand. In fact, they were rolling out enough to meet 2 times market demand, and their competitors weren't. So basically, we formed this view that they were going to be able to grow. Not only were they in an attractive market, in many markets you'd love to see 6 to 8% demand growth after 30 years. I can't think of many businesses that have that kind of demand profile. So not only was it a good market, but then you layer in the fact that they'd actually be running volumes at twice that. And then you have a look at consensus expectations, and we formed the view that they were too low. So all that confluence of factors kind of came together, and we took a big position. I mean, to be frank, today we have sold a lot of that position. We still own it in our fund, but I don't think the argument for the huge overweight position is there today when the share price has a lot of that valuation gap has closed, and everyone's expectations have risen. I think people now have cottoned on to the fact that it's a market share gain story as well. So. But that's an example, I think, of when you run a concentrated fund, you really have to do the work. And then the final thing I'd say is, with a concentrated fund, sometimes you have to think about what businesses you're just happy to kind of let go through to the keeper. Like, I'm not saying that these businesses are bad businesses, but I don't, so I'll give you an example. So a business like a construction business, I think that's quite difficult to put in a fund like ours, because you sit on the outside and, the information that you get is maybe they've won they've won a $1 billion revenue contract to build, a light rail or something like that. And if they've modeled it internally correctly, then they might make a 5% profit margin on that. And if they've modeled it incorrectly, then they're on the hook for all the losses. So you as a shareholder are on the hook for all the losses. So that information asymmetry makes me nervous. We did a lot of work on Fletcher Building a few years ago. We went over I went over to New Zealand. I met with a number of competitors. So Fletcher Building have a lot of really good businesses, but they had this construction business. And I'd always had this rule that I don't like construction businesses. So I wanted to get a bit of comfort around that. And we met with a number of other construction businesses in New Zealand that had been underbidders on a lot of the tenders that they'd won. And if you added up the sort of the hundreds of millions of dollars that these underbidders had been out underbid by, you got a number that was pretty close to $1 billion. And that ended up being, I can't remember exactly, but they ended up being on the hook for between $1 or $2 billion worth of losses because they'd underpriced these contracts. So again, it's one where, the whole business, the way that they made money was not from their construction business, but it had a very different risk profile to the rest of the business. So I think sometimes you just have to say, that's not my type of business. We sort of feel the same way about, I guess I made some comments earlier about loss-making tech stocks. That they, I'm not saying they're bad businesses or bad investments, but they're not for us because they are reliant on equity funding. And I don't think it's a foregone conclusion that that's always going to be available.
Yeah. So I imagine one of the most difficult things about running a concentrated portfolio is knowing when to sell and knowing when to move on because there's a better opportunity out there. How do you think about holding time and when to sell? Like, do you have a usual holding time? Are you, thinking in months or years or decades? What's the thinking there?
I mean, it really does depend on the stock, but broadly we try to, we're forecasting 2 to 3 years out. We're trying to buy businesses for a 2 to 3, hopefully 5 year plus period, just because you do all this work. The best dividend for it is to own these businesses for a long time. But sometimes your thesis is wrong, and I think you should sell if you think your thesis is wrong. Like the reason you originally bought it isn't playing out. Sometimes you have to sell for an opportunity cost perspective. So, I mentioned we've trimmed some CSL and recycled that capital back into, ideas that we think offer better relative value. But there's also, this is all kind of, I guess, a bit of a textbook answer, but I think I've been thinking about this a lot. I think there's also a little bit of, there's emotion involved in it. When you're buying something, you really have to listen to your head, not your gut, because your gut's going to tell you you're wrong because you're buying something that's unloved or it's got a few flies on it, or, you really have to listen to your judgment, your head, your analysis. I remember when we bought Mineral Resources, for example, so we went substantial close to 18 months ago, and the stock had fallen from $20 to $12. Kept falling as we were buying it. It was at an all-time high short interest. I remember going to some event and it was a bunch of fund managers there, and for whatever reason the stock came up and somebody near me sort of scoffed and said, "Oh, that's a short." And I felt like an idiot. You immediately think I'm wrong, not the masses. And you really have to lean into that. You have to go back to your analysis and say, no, I think I'm right for this and this and this reason. So it's almost biological. Like you're safe with the herd. If you're out on your own, you're going to get eaten by wildebeest. Like that's what it is in investing. So you have to kind of like lean into that fear and try to be very rational. And then when it comes to selling, it sort of flips. Especially if the stock's worked for you. So you look at the ticker and you diffused with like positive energy and your mind's flooded with dopamine and you're like, I am an investing genius when it comes to this stock. It can be really hard to know when to get off the train. So then you have to listen to your gut. You know what your original assumptions were in your DCF. You know when you're in your DCF and you get the result that looks a bit low, so you get back in there and you nudge up your margin expectations. You lower your. Obviously, we never play around with that stuff. The dark arts of DCF. But when you've moved from being conservative to being aggressive in your assumptions. And sometimes I think you have to listen to that gut feeling. The bigger risk that you should always be aware of, I guess, with a winner and with a really good business is the risk that you've sold too early. because there's no bigger pain trade than watching. I'd give you an example. A guy I work with at Magellan, I hope he doesn't mind me telling this story. He sold some Magellan stock to fund a pool that he was building
What?
at like $15, and so this has just
Oh, no.
become the most expensive pool of all time. Anyway, so I hope he doesn't mind me telling that story. These are the things that you have to think about. So
Yeah.
I wouldn't sell, like, if the thesis was playing out and everything was going right and the evaluation's not in the realm of crazy, I would just keep the business because, valuation, it's I don't know if something's worth 25 times or 28 times, or I don't think anyone does. But yeah, selling is hard. It's definitely hard.
So you mentioned the Mineral Resources, Nick Scali, Premier Investments, CSL. Are there any other stocks that are sort of really piquing your interest at the moment that you're spending a lot of time researching on that you're allowed to sort of share with the masses?
Share with the masses. Yeah, sure. Well, one that we just put out our quarterly and we talked about this stock in our quarterly. So actually 2 stocks, so I'll talk about them. Tabcorp and Helios. So both fall into this category of businesses that we like where basically there's some asset rationalization opportunity where you can shrink the business and get better returns. And I think, broadly when I think about investing, there's 2 types of businesses you want to own. There's your CSLs and your REAs and your really good businesses where you make money. The only thing that everyone knows they're good businesses. They're always on high multiples. Basically, the only way that you make money is by holding them for longer than people. Everyone expects a fade in their modeling. And if you do the work that suggests that either the earnings expectations are too low or that people are fading the earnings too quickly and the quality of their barriers to entry and their sustainable competitive advantage mean that they're going to make super profits for longer than people think. So those are businesses where you want to own them for a very long time. But then there are other businesses that people unloved businesses where, reversion to the mean can happen quicker than people think. And that the best type of business like that, the best kind of turnaround is one where you've got a good business and a bad business. And you can do something about the bad business, whether sell it, spin it off, and then you've left with the good business and everything re-rates. Like an example of that, I wouldn't call it a bad business, but Wes Farmers,
I was just going to say that.
Yeah, it's not. It's definitely not a bad.
Coles, bye.
Exactly, but it's not.
Sucking up all the capital.
Coles isn't a bad business. Coles isn't a bad business, but it was more capital intensive, and I think that Coles does about a 15-20% return on capital. Bunnings 65% return on capital. It was being lost within the value of Bunnings was being lost within the conglomerate group. And so that was a really successful example. So for Tabcorp, they have the lotteries business. It's 65% of their earnings. And lotteries, fantastic business. I would call it, a toll road like business, but I actually think it's had a better year than the toll road. So
A lot of that is actually Bryce buying lotto tickets through COVID.
right, yeah. Well, that's the thing is and it's got this big tailwind of shifting online. Like people spend more money when it's online. They don't have to pay 10% to the retail to the newsagents when people buy it online. So for many reasons, it's a good business. I think we all know that. And then wagering's been a real problem child. And now they're in this situation where, so when we bought it, we thought that they could just spin off wagering. Now it looks like there's a number of bidders who are interested in buying the wagering business. But either way, it comes down to the fact that you've got different natural investor sets. Pension funds that have a very low cost of capital will be pretty happy to bid lotteries business standalone up to a pretty high multiple, but they don't want the cyclical wagering exposure. So when you split those 2 businesses, you're going to realize the value from a sum of the parts perspective. I think you're going to make money from realizing the different cost of capital for those 2 businesses.
I'm surprised in Australia that wagering's cyclical. I would have thought that would be as structural as...
Yeah, you know what? It actually is. If you look at the history, like the growth CAGR of wagering spend, it is a structural growth story. The problem for Tabcorp has been competition. They used to make a lot of money through tote, and the pricing is just too high versus the corporate bookmakers' fixed odds. So their price has been coming down, and they've had a number of headwinds that way as the market sort of opened up and you've had a number of new competitors come in.
Yeah.
So their earnings have actually halved in that business. So it hasn't even been cyclical. It's been a one-way structural ticket down. But there were enough reasons that we thought that was sort of bottoming out. Plus we thought, the corporate interest angle that the stock was too cheap from that perspective. And then the other one in a similar vein, just quickly, was Helios. So Helios, it used to be known as Primary Healthcare, And it used to have a medical center business, a pathology business, and an imaging business. And the medical center business was like the Coles. It was the actually much worse than Coles. It was, it was a bit of a broken model, if you ask me. Like, it never made a return above its cost of capital. Very capital intensive. And so they sold that problem child. And it also had too high gearing for us. We have a balance sheet filter that won't allow us to invest in businesses that we think are carrying the wrong amount of debt for their financial structure. And Healius was at about 4 times net debt to EBITDA. So in selling the medical center business, they got rid of their problem child. They brought their balance sheet back down to, below 1 times EBITDA. Add in the fact that they're making an absolute killing right now in pathology with COVID testing, which is, you don't put that into the multiple, but it's real cash that the business is going to be generating over the next 12 months or maybe even longer. And we think that, they've re-rated the business towards the better quality business.
Wow. Well, look, I could listen to you talk your book all day, but
I could talk my book all day.
we're going to have to take another quick break and just hear from our advertisers. So, Emma, whilst we could listen to you talk your book all day, we will move on. Given the year we just had in 2020, and the speedy drop and the recovery, and then the unbelievable end of the year for US tech stocks and the like, what were some of the major lessons you learnt through that year?
Yeah, I think whenever you have a market drop, like the speed of which we'd never seen before, it's always, for an individual investor, I think you can make a lot of money at these inflection points. And it's not about picking the bottom. Like, if you're trying to pick the bottom, you will not do it and you'll keep yourself out of the market. But at times when there's just panic and blood on the streets, it's a really good time to be allocating, capital to the markets. And so I look back and I think, what were look for the anecdotal signs that you're approaching a bottom. For me, it's, I had a friend call me and say, someone at their office was telling everyone to shift their super to cash.
Oh, yeah.
No. I was like, don't do that. For me, God, I don't think she'd ever listen to this, but my mum, God bless her, she's sort of my contrarian indicator. Like, in January, I should have known the market was at a top because she owns a bunch of stocks. She texted me. She's like, my portfolio is up 40% this year. I should be a fund manager. I'm like, signs from the top. And then in March, she was saying, I'm not buying any more stocks. The market's going down way worse from here. So again, that's my, your dentist or your Uber driver. For me, it's my mum.
You could package up that and sell it to other fund managers.
Yeah.
What's your mum saying?
That's true. Like a key short. Oh, God, bless my mum. She actually has legitimately done very well through her investments. So maybe she should be a fund manager.
So just on that, where, you don't try and pick the bottom, but it's an opportunity to allocate capital. At the time when the market was falling so quickly, we had a lot of members in our community wanting to put money in, but unsure about the actual strategy of how much to put in and how often to be putting it in. So do you have a strategy around allocating capital at that sort of point in the market?
Well, so for us, we can only run 10% cash as a maximum. And so we were kind of lucky that we were running pretty close to that sailing into the crisis. And that was, we don't usually try to time the market and take a view with our cash holding, but that reporting season, there was just very, very little value on offer. So we let our cash run out towards this buffer. So we had the opportunity to sort of bring that down as we saw opportunities while they were falling. But for the individual investor, maybe you could do it in tranches. Like, if you have, 50 grand to invest in the market, break it up into 3 and just say, I'm going to buy, a third of it every 2 or 3 weeks. The speed, it's worth talking about the speed of that drawdown because that was very unusual. In the GFC, it took 210 days for the market to fall 30% from its highs. In the Depression, so this is, when you think of the Great Depression, you think of people jumping out of windows tragically because of the speed of the wealth destruction. And that fell 30% over 30 days. So in March, it fell 30% over 22 days. Like, this had never been seen before. And I think a lot of the conversations that I was having and hearing were this view that we were going to have time to assess the information and know when to turn more positive. It just didn't happen. So I think it's a little bit of a lesson. Like, you have to, when the opportunities are becoming available to you and markets are gapping down, like, that in and of itself is probably a force that tells you that where you are on the panic to greed sort of scale. You could have bought anything. You could have bought anything in March and you would have made money.
Afterpay would have made a lot of money.
Exactly. You would have made a lot of money, definitely. I'm kicking myself that we didn't buy Afterpay at $9.
I know.
Yeah.
I remember looking at the screen being like, $9, crazy. and then did nothing about it.
But you know what? This goes to my earlier point that if March had gone on for longer and every drawdown in history would have told you that statistically it was likely that it was going to take longer than 22 days for the market to bottom, then businesses like Afterpay, they raised in July. Like they needed to raise.
Yeah.
Luckily, they raised at $60, not $9.
Yeah.
But they got lucky in that
Yeah.
respect. And buying it at $9, I remember at the time why you don't, because you think this business hasn't seen a cycle play out. And you asked me, I guess, about the lessons. I worry that one of the lessons of this downturn, is a bad lesson. Is that, and this isn't about Afterpay, but businesses didn't really feel the full effects of their capital allocation. We focus on balance sheets. So we went into the crisis with businesses that had better balance sheets, I guess, than the average company. But I think we should have, benefited a little bit more from that. Like it was really only Virgin that was allowed to go to the wall. Like we try to own the best or the second best player in a market, and a downturn or a recession can be great for the number one player because it moves out all the weak hands. So we didn't really get to see a full economic cycle play out. And I wonder about what that's taught people in terms of their risk tolerance.
I wonder on that as well. Businesses also, businesses with bad balance sheets were protected in some ways by, the Federal Reserve printing money and the Reserve Bank supporting the bond market and allowing them to raise debt that way. But then also the government stepping in and, paying JobKeeper and stuff like that and protecting their cost structures as well. Do you think businesses, there's sort of like they're learning that the government will step in and at some point the government won't?
Yes, is the short answer. I worry that would be the case. Now, it was a bit of a funny crisis in the sense it wasn't a typical credit sparked crisis. It was generally like, how do we put our economy on hibernation to keep people safe? So I think the government did the right thing in terms of opening the taps for fiscal stimulus. But you're right, like broadly, companies that make poor capital allocation decisions, that saying, like it's only when the tide goes out you see who's swimming naked. Yeah. I'm not sure how to turn this into an analogy without getting into, who was naked or not. But it was, basically really only Virgin and I think it was Grocon was the other one that were allowed to go to the wall. And we don't want to see companies going to the wall. I don't want to see, people losing money and people being permanently put out of jobs and things like that. But I just think for people's risk tolerance that it's a bad lesson to learn that we always had this view that, the Fed was going to step in, but now layering in that, the government's going to save you. I think, for risk tolerance and given where starting valuations are right now, I think that's a dangerous lesson to have learned.
So, Emma, before we move to our final three questions of the interview, we're introducing a new segment for our interviews this year. So you're the first cat off the rank.
This could go very poorly.
This could go the wrong way. We've had a lot of fun today, so we're going to be introducing the Fund Manager of the Year award. All we want to do is just introduce our audience through socials a bit more about yourself and all the fund managers that we're going to be interviewing throughout this year. But part of that is to get from you a stock, an industry, or a trend that you think we should be keeping a solid eye on over the next sort of 12 months.
Okay, thinking off the top of my head, I think, look, this is going to sound like a pretty vanilla answer, but a lot of the focus right now is like COVID winners and COVID losers and things like that. But what I would be watching is businesses that have been long-term beneficiaries of some of the changes, like the big changes that we've seen in society play out over the last 12 months. Like the obvious questions that we'd be asking are, what's the future of office? What's the future of online shopping? So I would be wanting, that I think there will be pockets of opportunity where everyone sort of indiscriminately sells off anyone that's viewed as a COVID winner. I'm saying that in inverted commas. And I think there are actually going to be some businesses that get quite cheap because they're in the COVID winner basket that actually structurally benefited from COVID. So I'm thinking of some of the online retailers, for example, Premier Investments. So the position that they're in now is phenomenal. They've got 70% of their stores on holdover with landlords. So basically rolling rents month to month. So when they go to renegotiate those rents, they've got a lot of power, and I think they can permanently enshrine maybe a 4 to 5% percentage point increase in their EBIT margins permanently as a function of lower rental expenses because of the position that they're in right now. They're also a beneficiary of the shift to online because a lot of retailers, online is actually dilutive. If you're a bricks and mortar retailer, a lot of online sales is actually dilutive to your group margin. It depends on how you're setting it up, but if if you're giving free shipping, if you don't have a centralized DC, if you're getting the product from individual stores and shipping it to the customer, if that's your online strategy, then it's dilutive. Whereas for Premier, because they've invested in this centralized DC and a number of other reasons, they actually make more money from an online sale. So they're pretty happy to see their sales shift online. And I think in the future, they'll go forward, hopefully, with a pretty similar number of sales and growing, but with the mix of that sales coming more from online and less from bricks and mortar retailers. So I would be thinking about that. Like, I think there'll be a time where the market will just really quickly go, all right, vaccines, it's all back on, baby, like long all the opening up trade, short all the stuff that worked last year, and actually you're going to get an opportunity to buy some really good businesses in that.
So we really want to thank you for coming on today. We're almost out of time, but hopefully this won't be the last time you join us. If anyone in the Equity Mates community wants to find out more about yourself or more about Airlie, I hope I said it right that time, where should they go?
So our website, so just Google Airlie Australian Share Fund. We've got a lot of information on our website. We share a lot of stock stories, quarterlies, videos, things like that.
Nice one. Now, as Bryce said, we do like to end with the same final 3 questions. So we'll get stuck into them. And the first one is, do you have any books that you consider must read? And these can be investing or otherwise.
Yeah, I'm glad that you said that the otherwise part, because like I know a lot of people and a lot of friends I have in the industry that are sort of like, they'll only read a book if it's, Howard Marks, or they'll only go to the movies if it's Wolf of Wall Street. And like, I'm not. I did that when I was younger. I read all the investing books, and I'll read if it's a really good or somebody's recommended it to me. Now I'll read it, but I prefer fiction, non-fiction, anything but investing, really.
Yeah.
I think you never know where you're going to get information. Like, I was at Nelson Bay for a holiday last week, and they just had a bookshelf there, so I just picked up Mao's Last Answer, and that's a biography. And I just walked away from that thinking, like, if you want to understand why the Chinese people have this pact with the Chinese government where they're willing to give up a bit of human rights for ever-increasing economic growth and standard of living, like, read that book. Like, read about what life was like for the average Chinese person in the 70s in the Cultural Revolution, and it'll teach you everything that you need to know. So you never really know where you're going to get a lesson. So I think reading widely. For investing, the number one book I'd recommend is a book called, so it's by Marathon Asset Management, and it's a book called Capital Returns. I'm sure people have recommended this on your podcast before, but so basically, oh God, it's such a good book. But basically, it's a bunch of their investment letters over the years, and the research that they've done. But their idea is about investing through a capital cycle. So it's just, and it's very easy to understand. Brilliant book. Another one, anything by Joel Greenblatt. I think he's a really good writer.
The little, what was it?
They've
Book
got
That
such embarrassing names.
I know.
Little book that meets the
still
market.
beats the market.
Honestly, that's what we're finding throughout the investing landscape. Like, one of the best basics books we've ever read was Patrick O'Shaughnessy's, but he's called it Millennial Money.
Yeah.
Terrible name.
Terrible name. Yeah, exactly. Other like non-fiction books are like anything by Malcolm Gladwell. I just read his new book. It's fantastic. There's a book called Factfulness by Hans Rosling. That's brilliant. Another one in a similar vein. So basically, like, the thesis of that is that the world's just gotten so much better on any measure that you can look at. And so often you hear people say, like, things have never been worse. Like, think of that last year, If our generation's like World War II is like sitting at home and watching Netflix and baking sourdough, like, ship it in. I don't mean to, I know people were dying, but you've got to put it in the context of like 100 years ago, people were dying of infectious diseases at a rapid rate. Infant mortality was through the roof. So in the context of where we've come from, I think there's always reasons to be really optimistic and put the challenges that we face in context. So Factfulness, and another one in that vein is anything by Steven Pinker, but he has this really good book called, I think it's called, what's that saying? Like, The Better Angels of Our Nature? Is that the same?
Yeah, that's the same.
So that's the book. It's about the history of war. But again, like, when you read it, you're like, God, we had some really horrible ways of killing each other thousands of years ago. So, you read these books and like they're terrifying, but I think it's useful to know where we've been and where we've come to.
Yeah, that's a great list. So the second question, which we're trialing again this year, in 60 seconds, what's the best business you've ever come across?
It sucks because we don't own it. We've never owned it. And I'm sure you get this answer a lot, but it's got to be REA.
Really?
Yeah.
Why is that?
Because, so if you think about it as a user, you sell your house maybe once every 7 to 10 years. You've got no idea what the price of marketing is every 7 to 10 years. So your agent says, oh yeah, and it'll cost you $2,500 to list on REA. You're like, yep, cool. You've got no idea if that's been inflated or no idea. And what's your alternative? Like, are you going to stick a sign up in the window of your house saying like for sale? No, like
Not
it's
bad.
Gumtree.
exactly, like it's the biggest asset you own. The difference between meeting every eyeball possible and not can be hundreds of thousands of dollars. So you'd never try to scrimp $2,500. Actually, I know some people that probably would, but most people never would try to scrimp $2,500. So really, honestly, over time they could double that. What are you going to do? They've totally skewered the market. I know, look, Domain is probably in a similar vein in some pockets. But if you did have sticker shock, it's almost as though as more expensive that REA becomes, the more likely that you drop the second player. So if you did have sticker shock at the cost of marketing, I do worry that, maybe it would be Domain that you didn't go for. And then all of this is in the context of the fact that, before REA and Domain, we used to spend a lot more money advertising in print. So, a really big print campaign today, you could be spending $10,000.
Yeah.
So I actually think the value that, that consumer surplus, like the value that it gives consumers is more than the cost of the advertising. So it's a business with pricing power, very high margins. And I say, it's painful because we don't own it because we come so close at different points in the past. And I've made that mistake that is so easy to make of thinking, the multiple's just too high for me. So that's something that I always try to push back against because, for a business with phenomenal returns and free cash flow generation, the multiple is always going to be high. It should be high because $1 of earnings from that business is worth more in your pocket than $1 of earnings in a capital intensive business. So yeah, it should be high and that's a mistake that we've made.
Fair enough. I'm really liking this question. We're getting some good answers.
What's the most common answer?
Well,
You're the
it's
second person
second
we've
time we've
asked.
asked it. First answer was Macquarie Group.
Oh, right. Okay.
Yeah.
Yeah, we own that. That's a good business.
Oh,
Yeah,
nice.
they're a very good business.
And then the final question, if you think back to your younger self, when you were getting your first 10 Commonwealth Bank shares.
50.
50.
Yeah.
What advice would you have for your younger self?
I guess is what I said before about like you don't have to study finance. You don't have to take this cookie cutter path. I feel like embarrassed a little bit when people ask, even your CV, like it just feels very vanilla. Like I went to Sydney Uni, I studied commerce, finance, economics, and then I, did internships and then I went straight into this industry. And that's fine. Like it's worked for me, but like I think maybe I would have had more fun or stretched my brain a bit more if I'd done something else. Like I think the UK model where you go off and study whatever, like if you want to study Russian literature, like ship in the Dostoevsky. Like you don't need to study finance. Like that would probably be my lesson.
Great note to finish on, Emma. We have had such a ball with you today. It's been very interesting, and I know a lot of our audience would have got a lot out of that interview. So I very much appreciate your time. And as Ren said, hopefully it's not the last time this year. So
No, thank you very much for having me.
Thanks, Emma.
And for the rest of the Equity Mates community, the podcast doesn't finish here. You can keep in touch with us at equitymates.com. If you want to contact us, you can hit us up at contact@equitymates.com. Don't forget about Comedian v Economist and also our Get Started Investing podcast for the beginner buffets out there. But Ren, until then, it's been fun. We'll chat next week.
Yeah, sounds good.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.